morning and welcome to the VSA Morning Mine. It's Thursday, the 17th of April, just ahead of the long Easter weekend. Paul, how are you?
Very fine, thank you. Very fine, and the weather's looking very, very nice outside at the moment. Clear, sunny skies.
It is indeed. Right, there's quite a bit of news out this morning. I don't think we'll be able to cover all of it, but we'll start with announcement out from Cleantech Lithium.
Yeah, VSA client, their Cleantech Lithium. They have announced a collaboration with a subsidiary of the chemical company DuPont, specifically DuPont Water Solutions. And DuPont has a nanofiltration membrane tech for high lithium recovery, and Cleantech wants to try it on their DLE pilot plant there at Laguna Verde, specifically to see if it will be applicable for their technology. And if so, it would eliminate the need for thermal evaporation and crystallization in the production of battery grade lithium carbonate. And if that it does in fact work for Cleantech, it means a significant cut in the commercial scale plant capex as a result.
Crystallizers being probably about the most expensive thing in a lithium plant. So if you can remove that step, that is a very significant capex saving. So interesting to see what happens in that testing. There's news out from Iofina as well, Paul.
Yes, that's right. That's a guidance cut from the London quoted iodine from brine, a producer in the USA, listed here in London, called Iofina. And specifically because of weather related issues around their plants there in which is essentially in the central United States, Oklahoma, Arkansas, Kansas area there, where they treat well field brines from the Smackover Formation, the Smackover being a lithium enriched oil field brine. Because of low temperature weather there for an extended period in the first quarter, their production rate has been lower than forecast, and as a result, they have cut their guidance for the year from their various plants. It's a cut of about 10% so far, and they said that they will update the market yet again on production rates when they release their full year results in about another month's time. But in the meantime, not helpful to see, particularly when you've got a stronger market environment for commodities for the most part in general, except for oil, of course, which is showing weakness at this point.
Very good. Okay. Yesterday we had full year results out from Elemental Altus, the royalty group.
Yes, that's right. Record revenues for them of 16.3 million US, and adjusted revenue also a record of 21.6 million, which is up 39% from the 2023 period. Gold equivalent ounces came in at just shy of 9,000 ounces, which is actually down about 100 and some ounces in gold equivalents from the 2023 level. And I would consider that to be a small miss on what the management was anticipating, and that's a result of the particular project called Corrales Sud. Initial production has been pushed into the Q1 2025 quarter, so missed out in getting contributor to the 2024 results. Operating cash flows brought 42% additional money on 2023 there, and the EBITDA was up to 15 million, or up 53%. They have repaid 27 million of debt and expect to have all debt off the books by the end of the Q1 2025, which means that they should be debt free at this point if once they report those Q1 results. So they have an undrawn $50 million credit facility, which means that they have some money to do deals if they've got something in mind, and otherwise a fairly good story there for Elemental.
Yeah, debt-free is a big step, and I think they have achieved that now. And the guidance as well for 2025 is revenue of $45 million. So another big step up expected this year. And I think that guidance, along with the debt-free news, is part of the reason that the stock has bounced back up in the last couple of days. Now that the market's starting to understand the impact of the benefit of higher commodity prices and new ounces in the portfolio. So looking good there. Anything else, Paul?
Just to say, the West African gold producer in Burkina Faso, an ASX listed company by the same name, West African Resources, had their quarterly activities report out. All-in sustaining cost is an important number showing there at the all-in sustaining cost of $1,262 US, whereas their unhedged Q1 average sales price US $2,800 an ounce. So that should show a very nice performance going forward for the rest of the year for West African as well. And recognize too that Burkina Faso, where they're operating, they haven't had any particular production issues yet, but there is, of course, a reduced level of investor sentiment on that country.
Very good. Oh, should also mention that F3 Uranium has launched a 7 million Canadian dollar bought deal with Haywood Securities, which is a flow through deal. So that's at 24 cents a share. There is a couple of days before this closes with an over allotment provision. So we'll see the result of that after Easter. Okay, Paul, I think we'll call it a day there. Thanks very much for your thoughts and have a good Easter.
And we'll be back on Tuesday of next week.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.